Today, folks, I know for an obliterate fact that there are money market fund, savings account chasing, cash stacking degenerates that will not blink or shed a tear for the face ripping market rally that we're experiencing in Bitcoin, in Tesla, in the S&P 500. These degenerates only care about low beta, stabilized income. And right now they've been locking in 5% yields unlike anything we've seen in the last decade on the back of one of the worst inflation cycles imaginable, knowing that 5% probably just caught up with inflation, but these guys don't care. These guys are also going to be really scared and annoyed when those interest rates go away and they have to figure out what they're going to do with the trillions of dollars that are just laying there that will be making nothing when we go back to 2% rates. And my speculation in this video is that this money is going to pour into dividend stocks, and we are at the early stages right now of a dividend stock recovery that we're going to break down. So if you are on a path to financial independence, if you damn well one day want to retire early, go hit that subscribe. Join me on that journey for interesting facts like this, because right now money market funds, even on the back of a face-ripping market rally, hit 6.59 trillion, another record for Q3 of this year. I mean, we jumped $79 billion to record frigging highs. How do you comfortably do this knowing all the opportunity that has existed in the market and how cheap things were in 2022? I mean, if you take a look right now, these kind of investors, and I think most investors right now should be avoiding Bitcoin. They should be avoiding the Tesla rally. And the only reason I say that is the people that make real money are the people that believed in it and cost averaged into it over the last year or two. If you just heard your buddy, it's like now's the time to buy, you're an absolute degenerate moron. You need to really pick assets you believe in, build a portfolio, and then cost average over long periods of time. That's how we make insane amounts of wealth. We don't FOMO in when everyone's buying. We've seen how that's worked out with like so many crypto assets like NFTs, right? So we're just in a new bull market. Relax. Take it easy here, guys, because I really think that the best bull market that is starting that really wouldn't have kicked off without the interest rate cuts is the dividend side of things. And this is where I'm most comfortable investing right now because valuations just do not make sense in tech. Most investors like Warren Buffett, people that have huge amounts of cash, recognize that tech companies are in a very speculative place right now. But when you look at the lower half of the market, and I'm still betting that that could really make up any lackluster returns in tech because it's just been far too undervalued. And we're seeing that now as SCHD starts to rally. Why is it rallying? Because we're getting interest rate cuts, and most dividend stocks are more acute to basically higher rates when it comes to their debt, their cash flows on those debt payments, when it comes to acquisitions, when it comes to share buybacks, and just about anything you can do with financing. These companies haven't been able to do very well, right? But now look, even VDY on the back of the Canadian interest rate cuts, there is a 1-to-1 correlation to these stocks rallying versus the interest rate cuts. And yet we haven't seen a dime from money market funds even begin to flow in yet. I think we are truly on the grounds of a brand new bull market for dividend investors, which is why I'm super thankful that I was able to spend the last year or two really loading up on SCHD. I was trying to get about 100K in here, and we just touched it on the recent rally, which blows my mind because in my RSP, I thought I'd have to wait till next year to have more contribution room. And I feel like I've just built the absolute perfect base for this new like rocket ship to lift off. And again, we're not going to talk about like face ripping returns that we've seen, in Tesla and some of these tech companies, but we are very fortunate to probably see outsized returns to historical averages because we were buying the lows, right? I mean, we're up 17% now, and we definitely increased our dividend just because the Canadian dollar tanked so bad. So as a Canadian buying this, I've seen outsized returns. But where I've really seen outsized returns is obviously playing some of the hype cycle. I mean, I bought Tesla at 180, sold it at 248 for a 40% return, made like 30K was like the total position that I pivoted into VDY. VDY then went up 10%, giving me a 50% return just on this money, allowing me to inch out higher gains than I would have got otherwise just buying the S&P. So I'm very thankful to have had that this year because I didn't have the stomach to ride through the Trump trade and actually like follow Elon through to see if they would win the election, because something tells me the market would look dramatically different if Trump didn't win the election. Whether you like him or hate him, it would have detrimented Tesla greatly. So now everybody's FOMOing in, and I feel like I missed that boat, and I'm not too excited to buy when everyone and their grandmother's buying, which is why I'm continuing to focus on the assets that people just aren't paying attention to. And if you break down some of the components of SCHD, when you look at BlackRock and Cisco and Home Depot or Bristol Myers, you'll notice that all these stocks literally have correlated with the cut in interest rates. I mean, these stocks have basically just been in the gutter. Like, they haven't even reached full recovery mode yet. They're just starting to get back there now on the back of tech that was able to ride through this, because tech obviously had better liquidity, way more cash, way less debt on the balance sheet. That doesn't make techs any better. It just means that they were more, equipped to handle this market environment. And now tech has become largely, in my opinion, just overvalued. It's very expensive. So I'm very much looking forward to, not as financial advice, but to continue to cost average here where it makes sense. Like, I'm going to keep buying the S&P as well. Don't get me wrong. It's just, I think I'm going to dedicate a lot more attention in the latter half of this year to really just finalizing up and building out the dividend side of my portfolio, because again, these stocks have not done much for the last few years, and people always like to crap on the things that have underperformed. I mean, look at Bristol Myers here. I mean, this thing is skyrocketed as of recently. I mean, year to date, it did hardly anything up till recently. So I'm very excited to see where this goes. On the Canadian side of the border, I'm not as aggressive here, but I think there is still some undervalued, stocks, because again, they haven't fully priced in the interest rate cuts yet, and we're just getting to the other. We went through the eye of the storm, and now we're on the other side of it, and we're just getting there. I'm so excited. Like, I don't think people appreciate, how predictable this really seems to be. But with Royal Bank and Toronto Dominion and Enbridge and VDY, the top three holdings and my favorite monthly paying Canadian dividend ETF, Royal Bank, with the purchase of HSBC, that acquisition they did, have been able to outperform the S&P this year, which is incredible for just a bank that has a very modest price to earnings multiple, making up for the lackluster return in TD. Now, TD, I think, is undervalued. They've gone through a lot of pain. They've been paying fines on the back of money laundering that, is very unfortunate for the bank to have experienced, but I think it's suppressed the value that this company still has, and that there's still great return potential. And even on the likes of Enbridge, again, these are like utilities, pipelines, huge infrastructure bloodlines to North America, and they didn't do anything until the announcement of interest rate cuts. And now we're off to the races. Though I am a little bit concerned that we have to worry about, drill baby drill. If Trump really wants to implement that policy, which I doubt he's going to, because oil's already cheap enough. But if he does do that and we see oil prices further decline, it's very likely the oil industry is going to get hit. It's going to go down. That's materially what happens when commodity prices go down, commodity stocks go with them, and we're still seeing suppressed oil prices. So we need to see how that story pans out. But like I said, when it comes down to everything, cost averaging and just not even being early, just being consistent has paid off better than trying to time the market. We've seen the likes of Meet Kevin. If those that follow Meet Kevin, he introduced a pricing power ETF where he presumed stocks that had incredible pricing power like Tesla and Nvidia were the stocks you wanted to hold for the long term. And then somewhere in between, he flip-flopped and realized that he knew better than the market, because he has a team of people feeding him data, thinking past performance could equal to some future return based on the data he had. And now he's down 15%, doing the most degenerate things that any investor should avoid doing. Because if we take a look, I mean, we're talking about shorting Bitcoin. He owns shorting Bitcoin, getting 20-year treasury stocks that are 3x shares, McDonald's, Yelp. Like, what happened to Meet Kevin? It's like this guy lost his way and literally missed out on one of the most opportune times to make money in the market, which comes to the point, if you miss the most opportune times when the market rallies the most, you typically miss out on the best parts of your return. Over a 30-year period, if you just miss those handful of days that offered the best returns, you got smoked. And, Meet Kevin got smoked. This is why you always want exposure to the market. And I wish Meet Kevin would, publicize his returns, but at least now we can track them and actually see what the performance is. And I feel bad for any person out there that got sucked into Meet Kevin's investing thesis and actually is paying this guy like a 0.77% expense ratio on the back of just utter lies. Like, I mean, you read into this pricing power ETF and it does not describe anything. So I come back to the really simple idea of investing that, hey, people are going to want yield. They're not going to be getting yield off interest rates. As interest rates cut, dividend stocks, infrastructure stocks, they're going to do a lot better. They're going to have way more cash flow. It is almost an inevitability at this point, and it's something that we're still in the early innings of that's very easy to buy, not as financial advice, just as a influencer clown and what I'm doing. And I'm just going to keep buying these fairly aggressively at this point. I do want to just kind of, really oomph up the portfolio here sooner rather than later in our tax-free savings account, especially at the beginning of the year when we get that extra contribution room. But you'll have to subscribe. You'll have to see what's going on with my portfolio because, yes, I do own Bitcoin. Yes, I own speculative assets a lot longer than you guys probably have at this point. And yes, we're making some really healthy returns on it, though they're not huge positions in our portfolio. We already were in there. Don't buy when everyone else is buying, folks. Buy when people don't care. And right now, people just don't care about dividend stocks. So that's just my humble opinion as one passive income investor to another. I'd love to know what you think in that comment section below.